All right, so let's wrap section 4 up with a little recap. And if you can remember, we started off the section talking about this random walk concept, and we looked at the continuous model, that stochastic differential equation, that assumes that prices move according to a normal distribution. But what we found when we looked at the data is that outlier moves are much more common than what the model would predict, and tiny moves happen much more often than what the model would predict. So if you remember those Excel sheets, we had that black normal distribution line, then we saw those empirical blue columns kind of pop up above the curve in the middle and then also on the tails. So that is where the model primarily fails, and it really underestimates the large, huge moves in the market. But we transition from there to the binomial tree to illustrate the fact that, yes, this model doesn't work, it's not perfect, but large moves are statistically less likely to happen than small moves. And if you can remember, we had that tree function, and let's say the stock price was at 10, it's harder for it to trend to, say, 20 than it would be to trend to 11 over the course of a month or so. So we use that binomial tree to illustrate that concept there. And then we finished off by talking about embracing the randomness because it's much more likely for any trade placed to just be a zero-edge trade. So we don't have to come to the market and be extremely scared for our capital in every single trade that we put in there. The most likely outcome is just zero. And so finding even a consistent negative edge is actually something that we could perhaps turn into a positive edge. So we can embrace the randomness and know that the break-even case is actually the most likely outcome for any old trade. Then we segued into the noise versus signal lecture, and we emphasized staying clear from high noise markets because they're more choppy and harder to trade as a directional trader. And then we went into the efficiency ratio. We ran through that example so you could quantify choppy price action if you preferred quantifying instead of looking at the charts. And then we discussed how markets with more participation have more noise. So as markets gain more players and more competition, they tend to have more noise and a little more randomness versus newer frontier markets have a little cleaner moves and the price action signals are in general a little bit more reliable. Then from there we went to the momentum and mean reversion portion of the course, and we looked at a bunch of data and a bunch of studies. And so if you remember the macro studies, we concluded that momentum dominates primarily in the midterm and mean reversion dominates in the long term. And we looked at those studies from Gary Antonacci and Med Faber. And then we went into the tactical take and looked at some of the work that Adam Grimes has put out. And we saw that equities tend to show mean reversion characteristics. We went through all those different tests like fading 3 sigma moves, buying breakouts, etc. And then futures and FX tend to show momentum characteristics. So interesting things to keep in mind going forward when we're looking to trade equities, say, versus futures and FX. And then we finished off with the discussion of volatility, and the two primary ways that people measure it is ATR, average true range, and historical volatility. So this one's a little more intuitive, but we talked about the flaws when a stock goes from, say, 50 down to 5. The ATR becomes sort of irrelevant because of the big price change. And then HV is a more academic way of looking at it, and it's a little bit less intuitive, but we talked about what it means and how to turn that annualized variable that it's reported in into the daily expected move. And remember, that was you take the HV number and divide it by the square root of 252 to get the expected daily move. And then we talked about how volatility is not trending, as things get confused a lot. A lot of people say, hey, we need high volatility to trend, when that's not true. We can have low volatility trends. We went over some examples of that. We can have high volatility consolidations. And then finally, we went and talked about how this information can help us actually execute trades. So volatility goes from hot periods of high vol to low vol and back to high vol again. It ebbs and flows in this sort of nature. And so we can use that information to our advantage. And then we looked at breakout trades for equities qualified with volatility, so rising volatility. And we saw that the stats drastically improved when we were looking for breakouts along with rising volatility, coming out from the low end of the range to something higher. So Volatility is definitely a value add that we can use when executing trades, especially in breakouts. So just keep this in mind going forward. Now for section 4 action steps, I want you to take a paper count and try to lose. Try to make losing trades and keep bet sizes small so you can take a sequence of trades. And what you may find is that it's actually a lot harder to lose than you might anticipate. And that's because that break even state in the market where if we just put in a trade, it's actually most likely to break even unless we have a very strong edge. So unless you are very, very good at identifying losing trades, this account should sort of chop back and forth. And it's just a very interesting exercise. I've done it a few times, and you get a completely different take on the market, and you're sort of humbled by how good our tools and analysis actually can be. It keeps you fallible, it keeps you humble. So try the experiment and see what it does for you, and it might change the way you think about markets. That's it for section 4. I'll see you in the next section.